Good afternoon, everyone. My name is Matt Tepper. I am the Vice President of Global Marketing here at GDS Link, and I will be today's moderator. We want to thank each of you for taking your time out of your day to join us for today's webinar, Ride the Alt Data Wave or Get Swept Away, How Alternative Data and Custom Decisioning Solutions are Revolutionizing Lending. Today's discussion will be focused on the transformative power of alternative data in the customer credit lifecycle. This session is designed to equip all of you today with a comprehensive understanding of the profound impact that alternative data can have on your operations. Today, our panelists will guide you through the key aspects of the lending process, shedding light on the associated challenges. We hope to gain valuable insights into the pivotal role that data and risk analytics play in enabling informed lending decisions at each stage of the lending journey. Before we get started, I'd like to introduce our panel for today. First, Nathan Petrie is an analytics account executive at GDS Link. Nathan brings over 15 years of industry experience with a dedicated focus on credit scoring, process management, and leveraging alternative data for credit decisioning. Having collaborated with more than 150 lenders, he has successfully implemented automation and improved risk assessments in their processes that have resulted in consistent revenue growth. Nathan's deep understanding of systems and data insights position him as a leading expert in empowering lenders in the digital data-driven era. Welcome, Nate. Charlotte Godner is the VP of Sales for the fintech vertical at Equifax. For more than 25 years, Charlotte has been focused on leading successful teams to drive innovation and thought leadership within financial systems. She is responsible for launching the fintech vertical practice at Equifax, building a dedicated organization of specialists in product management, data and analytics, customer fulfillment, and marketing. Charlotte consults regularly with today's future designing companies to help expedite responsible growth in lending, with a mission to expand financial opportunities, allowing all consumers the freedom to live their financial best. Welcome, Charlotte. And last, we have Jose Sequeira, our VP of Product Management at GDS Link. Jose leads product management for GDS Link's decisioning solutions and has deep expertise in data and decision management and integration to ensure GDS clients take full advantage of our deep source repository to yield the precise decisions our clients are seeking. Jose boasts over 2 decades of international experience in decisioning technologies, product program management, strategic planning, and professional services. Prior to his tenure with GDS Link, Jose oversaw product management and global decisioning services for multiple credit bureaus and solution providers. Welcome, Jose. Before we get started, just a little bit of housekeeping. If you have any questions during today's discussion, please type them into the Q&A box in your Zoom control panel. In the interest of time and getting everyone in and out in a reasonable manner, we will address any questions toward the end of the presentation. This slide deck will be emailed out to all of our attendees later this week, and the webinar is being recorded. It will be available for replay through our website, gdslink.com, equifax.com, as well as other social media channels. Again, as we get going on today's discussion, I think let's level set here a little bit. And Nate, I was hoping that maybe you can help us find what we mean by alternative data and perhaps provide some color around some of the examples listed here, and perhaps help dispel what alternative data is not.
Sure, thanks, Matt. So I think we've all heard about this alternative data wave coming for years, but it might not be entirely clear to everybody. And from what I've seen in the industry, not always clear what exactly alternative data is. But the biggest question is sort of how can I use alternative data in my institution to give me lift, right? And so ultimately that's our goal, is to help them identify the data sources that are going to help them in various forms and really help them implement that in a meaningful way. So just to kind of start off, what alternative data is, really just focusing on what it's not. And I think really you can think of it as anything sort of outside the traditional credit bureau reports that have been used for decades. So you think of what we have on screen here. Some of the financial data is one of the bigger ones that you hear a lot of buzz about: open banking, getting those bank transactions. Some of the ones that are probably being used today, maybe not even recognized as alternative data in your organization, are on more of the public records, fraud tools, and those are already in place in many of the organizations. But when you start to get into things like DataX from Equifax, where you're looking at the non-traditional trade lines, utility type data, you can start to get a better picture of the outlook of risk, especially in those cases where they don't have traditional, deep or lengthy credit files. So, just once again, just kind of think of it as anything outside the traditional credit report provides some sort of lift and helps to augment some of the missing data that you might have with a certain segment of your population. So the unscorable, the unbankable lenders that are looking to expand in those areas are typically using this type of information in their scoring or in their rule sets.
And next, yep, go ahead, Nick.
Just one other thing I neglected to mention is the income verification. I think that's a big one, and a lot of the lenders we work with, they need to verify how much money the individual makes, and they may get that off the credit report. But there's definitely better sources out there for that, and sort of think of that independently of what they put on the application. So the work number from Equifax is a good example where I see a lot of lenders utilizing income verification data.
All right, thank you. Jose, as someone who's witnessed the evolution of risk decisioning products and solutions, can you speak to some of the specific benefits that alternative data can yield when applied to a decision solution?
Yeah, definitely. I think, just to elaborate a little bit more on what Nathan was saying, right, is finding a more holistic approach to an applicant or a borrower's risk, right? Using other sources of information that's not traditionally available in things like the credit reports, right? So how do you get more information on these applicants, and how do you get deeper insights? How do you get, if you think about the traditional credit bureau score, right? Two individuals can have the same score, right? But you don't know if they are, last week they were at 800 coming down to 600, or if they were 600 going up to 800, do you treat them the same, right? Where you can use alternative data to get a more holistic view, get other sources of information that can feed into that to really qualify the how you're going to treat this individual as they come on. Right. And Nate identified a whole bunch of different types of sources, whether it's banking data or employment data or income data, right? That just gives a more of a deeper understanding of the person that you're dealing with.
Everyone in attendance today is obviously keenly aware of the unique economic headwinds that all lenders are facing today. Inflation remains a bit high, rate hikes have paused for now. Unemployment remains low. Consumer savings and credit balances are moving in opposite directions. Charla, I understand that lenders have been increasingly exploring alternatives to traditional credit scores even before the pandemic. Given the current economic uncertainties, there is a growing demand for visibility on consumers categorized as the credit, including those who are credit thin or credit invisible. Could you provide some examples of how alternative data has been delivering measurable outcomes for fintech leaders? And likewise, how does leveraging alternative data enable them to identify the right consumers and create growth opportunities despite the prevailing economic headwinds?
Yes, absolutely. When you're new to credit, it can be extremely challenging to get credit, and it takes the right amount of credit to increase traditional scores, which also takes time. And you can be new to credit for lots of reasons, right? Either you're new to the country and haven't been established here in the US yet. You could be a young adult who hasn't started getting credit, or you could just be somebody who has chose to not leverage credit at this point in time. So lots of different reasons doesn't mean that you're a risk, higher risk, or not a good person. It just means that you, for whatever reason, haven't established credit yet. And if every lender used the same score and had the same risk thresholds, the same consumers would get similar offers from every lender. And there's a large population of consumers that would never get access to credit. And if you can't get access, you can't build it. So understanding that just because I don't have a credit card, an auto loan, or a mortgage doesn't mean that I'm not paying regularly in some other areas, like my cell phone or a rent payment or a non-traditional loan. Some cell phone payments today are actually more than car payments. And in today's macro environment, car payments are historically high. I mean, they're $700, $800, $1,000. So, and you're seeing cell phone payments very similar to that same environment, depending on how many people you have in your plan. But by leveraging alternative data, you can increase your approvals by while maintaining your current risk expectations. So on average, we're seeing lenders increasing approvals 21%, and we're seeing consumers move up the risk spectrum 45%. So that means taking a consumer who's a thin file that may have a lower score actually moves up that risk spectrum 45% when you layer in alternative data. And they're reducing unscorables by 60%. So lenders are really taking advantage of what else is available out there so that they can continue to maintain their risk while also approving more consumers. You're on mute.
So we've obviously, so we've obviously seen just through our discussion here, obviously what alternative data is, the value that it can create, and obviously it's a bit of the proof of concept around some of that value. Nate, as we delve into the customer lending journey, it becomes crucial to leverage alternative data effectively at different stages. Could you share some insights on how alternative data is best utilized in specific parts of the customer lending lifecycle? Furthermore, could you provide some examples of the data assets that prove most valuable in each stage, maybe and how they contribute to a comprehensive understanding of the borrower's creditworthiness?
Yeah, thanks, Matt. So obviously in the pre-screen side, sort of the name of the game is to keep your costs down and find out who would be potential candidates. So, not pulling traditional data, not going through your full process. We have lenders that, for much less money are able to pre-screen using alternative data and get a very effective process as a result. So not to say that they aren't as predictive as it would be with a traditional credit bureau. I think that it ultimately, can be, and it's really up to sort of how much data we have to kind of work with and build with. But I think on the pre-screen side, you see a lot of use for alternative data. In originations, you've got things like ID verification and fraud detection. That's non-traditional data, help you identify everything from synthetic fraud to, fraud theft rings. Another area in originations, I see a lot of uplift is in the second look modeling. So one of the ways, one of the concerns and one of the ways that folks work around the concern with some of the FCRA requirements is by using the data to say yes to a borrower. So if there are sort of marginal declines or marginal credits using your traditional data, you can run them through some of the alternative data and identify potential candidates that are not as high risk in a given tranche. The other, just really helping to better understand the risk in a given application, so you can set pricing accordingly, set lines based on their ability to repay and their income requirements, rather than sort of standard baseline policies, which I see in a lot of organizations. Everybody kind of gets the same deal if they are similar. The other thing I think that's important to highlight for originations is the public filing data. So are they in bankruptcy? Do they have tax liens? Maybe if they're a small business and you're lending to them, do they have cautionary UCCs already out there? Things that you'd want to know that really indicate severe risk for a lender, but they're not going to necessarily show up on your traditional credit report. But they're very important, and I think from a rule set perspective, widely used. On the customer management side, understanding when when folks get paid, do they have a job still? What is the risk inside my portfolio? If you think about everything we've talked about thus far, you might have limited data in the credit report. Your scores could be somewhat unreliable depending on the economic conditions. You really want to get a more holistic view of that borrower's risk. And so alternative data definitely helps there. Identifying cross-sell or upsell opportunities. So just like traditional data, alternative data can shed light on the risk that's potentially not visible, or those that are maybe less risky, but a traditional credit report shows them as higher risk. And then on the collection side, we've worked with customers on repayability models. So what's the likelihood and the ability of a particular borrower to repay you? And ultimately, you can model off of that, and that's largely driven by the alternative data. Things like open banking data are very predictive. And also from a collection standpoint, they let you know what day they get paid, how much they get paid, how often, and also all their obligations. So if you're getting paid first or last. So there's a lot of neat things you can do on the collection side by having them permission in the originations. Potentially they could utilize all that information through the collections journey. So it's really, about prioritizing your collections efforts according to the risk, combining that with the exposure and the likelihood that they would repay you. And when you sort of take it from that approach, I think your prioritization becomes more effective, and ultimately, you're streamlining a lot of the processes internally as a result.
Charlotte, it's evident that alternative data plays a crucial role in enhancing lending decisions. Can you elaborate how Equifax, as a leader in the industry, has specific data sets such as DataX and Teletrack already to address these particular use cases? Would love to hear about the benefits these data sets offer and any documented success rates that have been achieved by using these two products.
Sure. I believe every consumer and small business should have access to credit, right? We live in the United States. That's kind of the foundation of what we do. However, there are certain types of loans that don't fit into the traditional, quote, Metro 2 format, where lenders report monthly on account performance. For example, short-term loans that help consumers manage their expenses through the next pay period. These loans aren't even 30 days in duration. So reporting them on them monthly wouldn't provide a lot of value. But these loans are reported into what we call specialty finance databases, two of which are DataX and Teletrack, two acquisitions that Equifax made in recent years. And by looking at the performance on these databases, in addition to traditional credit, lenders are reducing their bad rates by on average 6.5% and increasing the performance of their models dramatically, with KSs from anywhere from 12.6 to 32%. So these databases have the non-traditional loans in there. They're short-term loans, they're lease to own, rent to own, they're payday loans, auto finance, subprime auto finance, and they're actually reported into these databases on a daily basis, not a monthly basis, not in the Metro 2 format. So very different, unique data than what we're traditionally used to seeing. Consumers who have accounts within these environments tend to actually be credit active, with 35% of them having inquiries on the traditional credit file. They are looking to access credit, but they aren't always well established within the traditional environments to actually be able to get the credit when lenders are only looking at that traditional data. So the challenges for lenders can be that they have just a lot of data, right? There's so many options out there. I mean, we listed them on a couple of slides ago of how many different data assets you can access. So at Equifax, we're trying to make it a little bit easier. And we took 4 of our key data assets and we put them into one score. Of course, we call it one score. But that score has just recently been released, just the end of first quarter. And it actually looks at the traditional credit file, right, which we call ACRO, but it also looks at telco utility data. So telco, how do you pay your cell phone, your utility payments, your pay TV? And it also takes into consideration both the DataX and the Teletrack database. And it's got 24-month of trended credit data. So you capture all of that information in one place so that you're not actually having to go out and pull multiple different data assets to build your own models. And OneScore was built on a 90-day past due within 12 months. There are two versions of OneScore. So you actually have one that includes traditional credit data, which is our Equifax ACRO file, and one that doesn't, one that only pulls in those 3 alternative data assets. And we're seeing lenders actually approve about 15% more applicants by leveraging this score. And if you want to move to the next slide. So this slide, actually, the chart on the left, I know this is kind of busy, but the chart on the left shows the hit rates on the alternative data assets on booked accounts. So if you look at, we'll look at prime, which is where you see the red in the middle that goes straight up. So for prime consumers, you've got a 68% are hitting the telco utility database. That makes sense, right? They have cell phone bills, they've got traditional utility bills, but you also have 32% that are actually hitting the telco database, and another 11% that are hitting the database. So just because you're a prime consumer doesn't mean that you're not also looking at some of these additional non-traditional types of credit products. If you look at the slide on the chart on the right, this actually is looking at unsecured personal loan performance of booked accounts with the OneScore. So it looks at OneScore with credit and without credit, right? We talked about you could get it without the ACRO file, and it compares it to our former alternative data score, which we call Insight Score, Vantage 3, Vantage 4, and also a income model that Equifax built called Consumer Income View. So within every risk band, scores with alternative data outperformed traditional scores. OneScore outperformed everywhere except for the deep subprime, where actually our traditional Insight Score performed a little bit better. But the Insight Score also looks at alternative data. It's just not complete with DataX and Teletrack. It's looking mostly at the telco utility database. So even in the prime segment, you see a lift over traditional scores by pulling in these alternative data assets. And of course, where it makes the most difference is the thin and young. Using the alternative data without the traditional credit file, you see a lift. So over the traditional scores, because again, the traditional scores probably don't have any insights into these consumers. So we are able to just pull in traditional data or non-traditional data and get some value out of that as well. OneScore is available today, again, with or without credit. And we'll talk a little bit more about validating that later.
Yeah, definitely interesting to see a little bit of proof of concept of seeing this alternative data coupled with some of the traditional metrics and just seeing the lift that Equifax is already providing. I'm aware that the Work Number, Charla, one of the offerings within Equifax's portfolio, has gained significant traction in the market. Could you provide us some more insights into this innovative solution? Additionally, if you could shed some light on the AltFi application indicator and its role in lending. How do these solutions contribute to streamlining the verification process and ultimately enhancing decisions?
Yeah, absolutely. The Work Number is really, it's an incredible data asset. Equifax purchased it in 2007, was a company formerly called TOX. And this was long before lenders, even mortgage lenders, weren't validating and verifying employment at the time. But certainly no one beyond mortgage was even considering income and employment as part of their application process. So since then, Equifax has invested a lot in growing this database. It's actually up to 2.7 million employers report regularly into this database. And it has 208 million consumers with current employment records. So it's by far the largest employer-provided payroll database available. It provides real-time, frictionless online access to current and previous employment and income information. Employers actually report in after every pay period to this database. So you can access it just like you would a traditional credit file in that real-time environment. There's no friction for the consumer. There's no information that they have to provide except for consent. It is an FCRA database, which requires permissible purpose and consumer consent to access it. But when leveraging it, 18% of consumers that are thin or invisible actually qualify as a prime or near prime consumer. just being able to really capture in what that consumer's employment information looks like. Who are they employed with? How long have they been there? What's their pay frequency? What is their income? Those types of insights are extremely valuable to lenders throughout the life cycle of the account, right? Particularly at approvals and funding, but even throughout in account management and collections. While this asset was originally developed for mortgage, right? Makes sense. Mortgage now really does require very intense employment and income verification. What we've been able to do is identify key segments within the database that actually work within the general lending environment. And we've taken those segments out and put them into a product called AltFi Application Indicator. It's not as robust as the full mortgage report, but again, you don't need that when you're approving a $1,000 loan or a $5,000 loan. So the AltFi Application Indicator, it looks at the employment status. Are you currently employed? What your description is, what your analyzed income is, your last pay date, and your pay frequency. And I know that this solution is available through GDS Link today, but it really has taken all that valuable data, made it again in a frictionless environment for the consumer to provide access to this data.
It's worth mentioning, as you can see at the bottom of the slide, at the end of the month, we will be recording a new episode of GDS Link's signature podcast, The Lending Link, where we're sitting down with one of Charlotte's colleagues to dive further into the innovation around ID and employment verification. And I know both the work number and the AltFi application indicator will be focal points of that discussion. Which leads me to the final chapter of our discussion today, the partnership between GDS Link and Equifax. Originally conceived in 2007, this collaboration has empowered hundreds of lenders by providing them with comprehensive data solutions, valuable insights. Together, we are committed to promoting fair lending practices and driving financial inclusion. One of the advantages of our partnership is the global presence of both GDS Link and Equifax. This international reach allows us to offer custom data solutions and support to lenders across the world, ensuring that they can benefit from our expertise and resources regardless of their location. Today, GDS Link's Modelica platform offers several Equifax solutions, creating a convenient one-stop shop for lenders. Jose, we understand that GDS's Modelica platform offers lenders precise insights by leveraging its flexibility to incorporate multiple wants data sources, obviously some that we mentioned provided by Equifax, as well as alternative sources. Can you elaborate how the platform enables lenders to plug in these diverse data sources effectively? And how does this flexibility contribute to producing the precise decisions that lenders are seeking?
Yeah, good question. I start by saying that GDS Link has been around for decades, right? We've worked with hundreds of customers across hundreds of industries globally, and we've helped customers integrate with hundreds of global data providers, right? So, as a decision management system provider, one of the key features of our platform would be how do we make that integration and accessibility with our partners' data seamless? Right? How do we alleviate any of the development needs or technical requirements from the customer and take all of that into our platform and be able to provide that benefit to our customers? Right? So we have what we call our data exchange. It is for all intents and purposes, it's a library of pre-configured connectors, right? Where we've already built and pre-integrated with these data assets like the work number from Equifax and all of the products that they have, so that our customers don't have to worry about technically plugging in and getting access to that data, and they can focus on using the data in the decisioning that they need wherever they need to plug it in, whether it's in their pre-qual or pre-screen strategies, originations, and collections, right? With that, right, in our partnership with Equifax and our partners, right, we proactively, under our partnership, proactively are engaged to talk about, hey, what's Equifax releasing in the next quarter or the next year to stay ahead of the products that are coming up, right? So we can provide those to our customers on a timely basis, right? We want to be that that partner to our customers that provide the options to them without them having to go through a big exercise in order to get access to all of these revolutionary, innovative products that are coming out into market.
And thank you for that, Jose. In January, GDS was proud to announce our integration with Equifax's Ignite, a cloud-based platform that takes the best of data and analytics with decision execution. Charla, so you can expound on this new innovative offering and how this is unlocking a new level of insights.
Yeah, absolutely. So we've talked a lot about alternative data and all the different data assets that there are available out there. And there's a lot, but the key is really leveraging the data is the key and linking, being able to identify Charlotte Godby here across a variety of different databases to show a true and complete picture of her financial situation is where lenders can develop models and strategies to say yes more. Ignite pulls all the data, all of the Equifax data assets together in one environment. So lenders can link their customer databases and see the full picture of those consumers. And partnering with GDS Link provides the best of both worlds, right? So you've got access now to all of this data, keyed and linked across the different data assets, but you also have the GDS Link expertise to really understand the value of the data across the life cycle of the consumer. And you really shortening your learning curve so that you can get to market quicker with better decisioning solutions.
Nate, care to provide any additional color around how this integration with Ignite can unlock new info lenders and how this works hand in hand with our model monitoring services that GDS provides?
Yeah, we love building models here and scores for lenders, right? And in order to do that, ultimately, historically, they'd need to have data and come to us with a portfolio or go to a bureau and purchase a large file, a proxy file, for us to be able to run that exercise. So this really opens the door. There's 5 years of consumer history, all of the DataX and Teletrack data loaded in there. And so if you think about from a modeling perspective, some of the benefits, having access to all that data, you can really build out robust models and get a really strong understanding of the probability of default with any given borrower applicant. Looking at it holistically with the alternative data is definitely a big value add. So we were able to load in some of our environment into the Ignite platform to enable us to build out those custom models. And then not only that, but test them. When we build models, we don't typically do one-off model builds. We develop a partnership with our lenders. And in a regular basis, we may need to retune or refit the models. So Ignite, once again, could allow us to go back into that environment. And as we're looking beyond just their portfolio, what is the larger picture look like? Maybe they're moving into a new segment and they don't know what to expect there. Maybe they want to test a new feature in their models, and they haven't been collecting that historically, right? This Ignite relationship allows us to append any and all data and assets that they would need for those modeling exercises. And it opens the door for folks that maybe don't have the resources in-house to build custom models. They can leverage our team and we can work together to build that out in a way where you sort of could feel comfort, sleep at night, knowing that there's a ton of data that went behind it and some robust analytics driving the analysis. So it sort of allows us, we try to be open box, and this is a good way for for us to be able to explain exactly what's going into the model and test out anything under the sun, right? Any scenario you could think of, we can pretty much run it through here and instantly tell you what the results might be. So I'm very excited about this. This is, I think from like I said, from a modeler standpoint, this is like, our dream world. So.
Awesome. Thanks for that, Nate. Before we wrap up today, before want to get into the Q&A session, if you do have a question, please type them into the Q&A box in your Zoom control panel. We have received a couple of questions thus far. Let me go ahead and start with this one, and maybe I'll pose this to you first, Charla. One question that came through: how do you foresee the role of alternative data in credit decisioning evolving in the future?
Yeah, I see it really changing the way lenders make decisions. It really is so critical. Like I said earlier, if everyone's using the same score and everyone has the same risk thresholds, there's no competition. You're always gonna get the same offer, and then it's just gonna be relationship on who you go with. You really need that alternative data layered in to help lenders be able to find new pockets to say yes more. Again, if you're new to credit or if you've had some negative experiences with credit in the past, doesn't mean your situation today isn't one that you couldn't afford to take on additional credit. But you're going to need that alternative data to really be able to help you do that. And I hope every lender in the future is using alternative data as part of their decisioning process, because that really is how we get all consumers access to credit. And that, to me, that's the key. Financial inclusion, really helping consumers live their financial best and get access to the credit that they need.
And I think the next question kind of piggybacks up a little bit, but Jose, I'll let you maybe tackle this one with the borrower experience at an all-time high priority. How does the use of alternative data affect the consumer experience?
Yeah, that is a really good question. There's an all-time high focus on digital journeys, right, and how to automate what traditionally might have been a manual step, right? And alternative data, alternative service providers, things like device verification, where it's not related to the applicant, but it's more related to where is the transaction or traffic coming from. Being able to, the example we gave earlier, being able to validate income and employment real time through a source versus having to upload documents and manually verify pay stubs or something like that, right? Really around removing the friction of that digital experience and being able to onboard customers as quickly as possible, right? And that's where I see a lot of inclusion of alternative data sources and data service providers, but as well the adoption and the willingness of lenders to use and leverage that information, right? And I part of that is because of the transition to online due to the pandemic, right? They had to be more comfortable and had to invest more into those digital journeys than they might traditionally have done in the past. But we are seeing a lot more uptake, if you will, of those services to automate and using and being more amenable to these alternative sources in order to achieve what traditionally might have been manual.
Nate, kind of two questions that seem to be kind of together here, so I'll ask them both at the same time. Are there any regular concerns with using alternative data in credit decisioning? And we had one kind of specific question: how is adverse action handled if a borrower does not have enough alt data to get an approval?
So, I mean, typically there's a couple ways, right? There's workarounds, and then there's alternative data sources that are FCRA approved. So obviously, if they're FCRA approved, you can use that, and they should, you should be able to generate directly from the data reason codes, and that's something that when we do the modeling with alternative data, we're able to produce our features, are able to produce those reason codes for a decline. If they're not FCRA approved, there's a little bit of hesitancy because ultimately that data source hasn't set up the roadmap for a borrower to file a dispute. And so in those cases, the data is still usable to say yes to borrowers, but lenders will often use the adverse notifications from the traditional credit data or FCRA approved sources. But if you're saying no to somebody today and you pull alternative data and you find that they're not as risky as they looked, maybe they had a 650 credit score and your cutoff's 649. So before 650 rather, before approving them, you run them through another data source or two, and you're able to identify these are some of those lower pockets of risk. If you thought about it in a joint odds table where you have two different data sources bumping up against each other. So, the idea being if you had 10% probability of default with a traditional credit score, there may be, out of those 9 borrowers that won't default, how can you help identify 2 or 3 of those that are less risky than the other group? And that's where alternative data can help you say yes to more borrowers, and then you don't have to worry as much about the adverse action or any FCRA requirements, because ultimately you can use anything to say yes, and nobody will, come knocking on your door. But if you start declining as a reason, then you either have to set up your processes to be able to manage those disputes and create adverse action notices and or key factors for decline, and then that can be designed and developed and ultimately approved. And there's a couple organizations, if you look in the news, that were able to do that with entirely alternative data. So being approved by the CFPB to be able to lend without traditional credit data is something that's occurring in the marketplace today, and more so. So it's really about sort of giving that path for disputes, and that's really the biggest hurdle that some of these data sources face. So, but I think more and more you'll start to see they're moving over into that direction. If they're trying to sell their data, they typically realize that where the pain points are with lenders, and quickly realize that they need a path into the decline section of a application. So hopefully that helps answer that.
Yeah, thank you. Charlotte, one question that came through that obviously seems like you might be best to answer this is what is Equifax's approach to educating consumers about the use of alternative data in credit decisioning?
Yeah, Equifax is really taking a very strong stance on financial inclusion as a whole, and really helping to educate consumers about credit in general, and what they can do to build their credit. We've got a nice campaign going on now that's really directed towards consumers on, how do you build credit? What's the right way to do that? And what alternative data sources are available? And like Nate was saying, the alternative data sources we talked about today, so the Work Number DataX Teletrack, the NCTUE, which is the telco utility database, those are all FCRA regulated databases. So every one of them, consumers have the ability to go in, see what information is available, and they can dispute it, right? That's the key with it, is you can dispute the data that's being reported if it's inaccurate. So that information is all available today for consumers. And again, I think that's where the FCRA really regulated databases really make a difference. But we do see the whole campaign for consumers, really, it is about living your financial best and how do you build credit, and doing that by, ensuring that all of your credit is where it should be. If you're leveraging a payday loan, fine, right? We know that according to the Fed study a few years back, many consumers need to get that $400 loan to tie themselves over to that next pay period. They need a new set of tires or something like that. But just because you have it, it still is important that you continue to pay those bills, and really ensuring that consumers understand that message. It may not be reported into that traditional credit file, but it still could negatively impact you if you don't keep up on those regular payments. So that's really the approach we're trying to take, is educate consumers as much as possible about the data that's available on them, and ensure that they, understand the value that data can bring to them, both in a positive and a negative environment if they don't handle it appropriately.
Thank you for that, Charla. Jay, with all the new data sources available today, how do you know what data to use and where? I know you kind of spoke upon data exchange, kind of giving folks a little bit of malleability. Thought I'd let you kind of tackle that one.
Yeah, I mean, that's a extremely good question because there's hundreds of data providers out there. And it seems like every day somebody new joins the conversation. Speaking from a GDS perspective, we have a team dedicated to having discussions with our partners, right? Identifying those partners that would be value add to our customers. And that's kind of how we position our data exchanges. What are those sources of information that would really benefit our customers? Those are the ones we kind of prioritize, like Equifax, right? Getting them all of their products readily available in the exchange and exposing those to our customers. Our team will attest that they get hundreds of emails a day of other providers who want to connect with us and integrate into our exchange, right? So we can only answer so many emails and get on so many calls to really justify or warrant the value proposition that all of them represent, right? So there are some that potentially a customer would even inquire with us about, and we would follow up and identify that source and whether or not it's a value to the portfolio as a whole, or if it's a one-off for that customer, right? We, with our strategic partners like Equifax, I would say we are, for lack of a better term, we're almost experts in their products, right? We're very well versed in what Equifax has to offer in terms of products, right? So we can help our customers consulting from the products that a partner like Equifax provides to us, right? But in other situations where it might be a relatively new partner or a new alternative data provider in the market, we might not be as well versed. We can potentially foster some connections, right? Bring relationships to the table, but we certainly wouldn't go to the consultative approach that we would with our partners like Equifax.
If I could add a little bit too, because I think on the analytics side, what we try to do in any modeling exercise, or if we're looking at data assets and the value they bring, is ultimately the proofs in the pudding, right? So if we look at a few different data sources and we see that one provides lift, you also have to consider how much it costs, right? So you sort of take those things into account, and you're ultimately only buying the data sources that give you some sort of lift in your process. But you have to understand where that is and how, sort of how much value it does bring. And really the only way to do that is with checking data. So, we do in a lot of cases where a client will come to us, they don't have the historic data from one of our partners, and we're able to append that data just like with Ignite, right? Where we can append that data to run those exercises for them. And so help reduce some of the lift with credentialing with the partners. They'll still have to credential if they sign up, but sometimes we can work to get data appended for our clients to do those tests. And in those cases, the idea being it's a lot less friction for lenders that do want to test out new data sources. The other thing I would say too is our decisioning software has some unique benchmarking capabilities and champion challenger type capabilities. So if you have the data, or you're able to access that data in some fashion, either through us or through the third party, that you could in theory run those on your existing book or on new applications in parallel, and determine exactly how much value they're bringing you in that process through that exercise. So I'm a strong proponent of the proofs in the pudding. We're data agnostic at GDS, so we're open to all and any sources that do provide lift for our customers, and willing to kind of take a look at those for you. If you have something that you want to test out and see if we can build a model for you, reach out, and we're happy to take a look for you.
Thanks, Nate. Seems at the end of the questions that we've received from our audience today. I will have all of our panelists' contact information if you guys do have any additional follow-up for our experts today. But before we wrap up, I want to once again use this time to promote the upcoming episode of our podcast, The Lending Link, with Equifax's Shelley Nischbach, where our host, Rich Alterman, will dive further into the work number and other innovations recently unveiled within income and employment verification. The Lending Link can be heard on nearly all available platforms, including Spotify, Apple Podcasts, Stitcher, or wherever you listen. Topics have ranged from analyzing macro trends in lending, financial inclusion, to our latest episode where we discuss the evolution and future of AI in lending. You are not truly in the know until you're not in sync with the Lending Link. Also, if you wish to see what Equifax and the other data sources in GDS Link's deep repository can yield for your organization, connect with Nate to how Modelica Pro can refine your current models as well as simplify your model governance. Likewise, Equifax recently published their latest economic insights from their latest Market Pulse webinar hosted last week, and I would encourage signing up for their monthly webinar series at go.equifax.com/Market Pulse webinars. Also, you can work with Equifax's specialized team of analytics consultants to understand the lift you can realize by using OneScore with your credit-seeking populations with a complimentary validation. Head to Equifax.com to find out more. I would like to thank all of you for your attendance this afternoon. I'd also like again to Nathan, Charlotte, and Jose for your insights. We hope you have all seen this as a valuable resource for you. Again, these slides and a video replay will be available later this week at gdslink.com, equifax.com, and our social media channels. On behalf of our panelists, I want to thank you all again. Hope you have a great rest of your day.